All right, Mubina, thanks much for giving us that update. Meanwhile, let's quickly pull up the buy now, sell now stock cloud as well to give you a sense of all the individual names you need to watch out for. Starting with JSW Steel, they've implemented a resolution plan for Bhushan Power and Steel. A sum of 8,600 odd crores was arranged in a wholly owned subsidiary through a mix of equity, optional convertible instruments to JSW Steel and JSW Shipping. Next up is Adani Transmission, another stock you need to watch out for. They've signed a definitive agreement with SL Infra Projects for acquiring Varara Kurnool Transmission Limited. JSW Energy also to watch out for. They've approved a proposal for issuance of green bonds by JSW Hydro Energy for raising about $750 million from international markets. Biocon, a name from the pharma space to keep on your radar. They've partnered with Lips Pharmaceutica to launch generic formulations in Brazil. HPCL has entered into a share purchase agreement for acquiring shares of HPCL Shapoorji Energy, which is an associate unlisted company of HPCL from SP Ports. Minda Industries has approved expansion of Balbal plant capacity to 1.8 lakh wheels per month from the current capacity of 1.2 lakh wheels. Then you also have the likes of Lumax Industries, which has approved capex of close to 80 crore rupees for setting up new manufacturing plant in Gujarat. You also have Shri Ram City Union Finance, which has declared second interim dividend of 10 rupees for FY21. You also have names like India Grid Trust to watch out for as far as the BNSN stock cloud is concerned. And lastly, there's Tata Steel as well to watch out for among a host of other names.
All right, let's go across to our guests for today. Then we're joined by Kunal Bothra. Thank you so much, Kunal, and good morning to you. And we also got Raghavendra Kedia, who is a managing director at MH Capital. I want to start with you, though, Kunal. Just what are the ideas that you would pick for us? We've had quite a decent start to the current series.
So, good morning, Alex. Morning, everyone. Yeah, I think it's a good start, and I think coming out, from a 3-day holiday into a 3-day weekday is quite rare, but it's good to see that the markets are following it up from where they left off on Friday. So that's the cheer sign for the markets that finally we've seen some follow through price action on the bullish mode for the index. Now on technical fronts, I think 14,750 is a resistance of sorts. So we are trading very, very close towards that resistance zone for the index. So if you manage to close above this, and sustain above 14,750, say with a margin of another 50-75 points on the index, then we could be getting back into that stable mode for the index. So I think in that light, I believe large cap stocks should do pretty well for themselves. Hence, I'm concentrating on 2 buy calls, and both of them are specifically from large cap names, and especially the ones which have been slight underperformers. But I believe that there should be more room on the upside for these stocks to move up higher. So first stock which I'm picking up is Aban Reliance Industries. I think that stock is trying to challenge back again its 50-day moving average, breakout. The consistent attempt towards the stock breaking below the 2000 mark, and we've seen all the time the stock managing to take support and demand arising back below the 2000 mark for Reliance. So I'm expecting that this time also as well, the stock will hold on to this 2011 and build up to the gains on the upside. Buy with a target of 2120, and stop loss could be kept at 1980. And the second is a barn large cap name, UPL, United Phosphorus. I think even this stock is inching towards a flag pattern breakout. What's interesting for UPL is the 3 previous trading sessions, all of them were on the negative side. Now the stock coming back, or ending the the March expiry and starting off the April expiry on a somber note. But the pickup of the price action today seems to be indicating that the expiry based selling seems to be over, and now the stock should be getting up for a decent expiry, at least from a 1 to 2 month perspective. So I would expect positionally UPL to do pretty well for itself. Short term traders could look at a target of 660, and stop loss could be kept at approximately 590 levels for UPL.
All right, top gainer on the Nifty as we speak, UPL gaining about 5% in trade today. Let me go across to Raghavendra as well. Raghavendra, good morning to you, and once again, thanks so much for taking the time. What are your high risk and low risk ideas for us?
Good morning, Alex. Let me begin with a moderate risk and high return idea, more on the investment side, that is Timken India. Timken India currently is trading at levels of 1250, and we believe that in 1 year, the company can give you a 30% upside to 1900 levels. Timken India is held by US parent, which holds 68% in the Indian entity. The US parent is a market cap of around 45,000 crore rupees, while Timken India has a market cap of around 9,000 crore rupees. So this makes Timken India a corporate action candidate, could be an open offer or a delisting since it is profitable, held by a cash-rich parent. On the Indian part, Timken India has acquired ABC Bearings 3 years back. This acquisition is paying rich fruits, as we see in the balance sheet. The management is very visionary and has an aggressive growth plan for Indian operations as well. The company makes anti-friction bearings and power transmission equipments. Both these products are largely consumed by auto space and industrial space, and which are going for an uptick across India and global. So the order book of Timken India for the next 2 years looks very healthy. Other comforting points for Timken India are around 13% FII-DII holding, cash-rich balance sheet, US or MNC parentage, generous dividend policy. Overall, Timken Group is 100+ year old. So we believe this could be a wealth creation idea. Buy Timken India at current levels for a target of 1900 for a 30% upside from current levels.
Okay. All right. Please stay with us, though, gentlemen. We'll come back to you in just a short while. We'll head into a break and be back on the other side with viewer queries.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. Let's move right on with some viewer queries then. First up is an email from Arvind Tiwari. He bought Glenmark Pharma at a price point of 466, pardon me. And he wants to understand what is the way forward and the outlook for the stock. Kunal, first coming to you on Glenmark. It still continues to hover around those 460, 465 levels, and it has significantly cooled off as well from the recent highs of about 570 rupees odd. What would be your advice at the current juncture? Should he stay put?
I think it's I think it's a very intriguing chart for Glenmark Pharma because, currently I've seen time corrections, I've seen consolidations, but consolidations to such an extent that I think, if I'm not wrong, for the last 8 or 9 months, Glenmark Pharma has been in a range of 45 to 50 points approximately. So 460, 65 points approximately. 460 or 450 is the lower end of the band, and closer to 520, 515 approximately is where you see the upper end of the band, for Glenmark Pharma. So after a rally from those March 2020 lows of 150, 180 levels to almost 540. It's a very interesting consolidation for Glenmark Pharma. Now, I would look at it in a manner that the stock is not correcting or retracing very sharply in terms of prices. Yes, in terms of time correction, it's taking I would say an extra amount of time for the stock to consolidate. But the price correction is not happening. Now, this is what I will take it as a positive stride for this stock. And I think for someone who's waiting patiently, I think now it's a matter of when that the stock would end this consolidation or a time-wise correction and break past or start a new trend for itself on the upside. So if you have held patiently for on Glenmark Pharma, say for the last few months, I would advise that you continue to hold on to the stock. And in fact, you can look at some short-term corrections as good buying opportunities or averaging opportunities for Glenmark Pharma. The breakout, as I said, is above the resistance level of 525 for Glenmark Pharma, and whenever that happens, I believe that the stock can restart a very strong uptrend for itself, maybe crossing even that 650 to 750 mark as well post that breakout. So upside seems to be very strong, it's a matter of patience. And I believe if you're holding it from a longer term perspective, you should continue to hold on.
Okay, what about you, Raghavendra? Do you concur with Kunal's opinion? He definitely think there is definitely more room for an uptick in this stock, but assessing the fundamentals, would you advise the same?
Good morning, Karunya. On the fundamental side, if you see the earnings of Glenmark, they have given an EPS of around 15 rupees in the last 2 quarters each. So that gives a full year EPS of around 60. Very conservatively, if you give a multiple of 10, you get a target of 600. On a multiple of 12, you get a target of 700 at least. So one can hold Glenmark Pharma at current levels. We also believe that dollar from here, the range is 73.74, could go up to 75.76, which could benefit Glenmark Pharma significantly, since most of their sales comes from exports versus domestic local sales. So one can hold Glenmark Pharma at current levels, and it's a buy on dips as well for a target of 600 in the next 2 quarters, and also 700 possible if one is willing to hold it for 12 months.
All right, let's go to the next one then. Arvind's got a query on Zee Entertainment as well. He's bought at levels of 212 per share. It's not too far away, the share price currently on Zee Entertainment, hovering around the 200 mark. He's looking at both the short-term and long-term views. Kunal, on the charts, how does it look? It's had a decent run in the year, but it has also been quite choppy. What do you see on the charts?
So yes, Alex, you've I think you've mentioned it right, that the trends have been quite the recovery has been quite dramatic for Zee, but the trends are very choppy. So if you look at it, that the stock I think in the month of August and September moved up from 150 levels to almost 250 to 25 zone, and then from there it consolidated, went to a very choppy kind of a trading range. And similar patterns for Zee has been found where the range has shifted up higher. So from a 150 to 200 range, the stock has moved down to 200 to 250 range. It's taken a lot of time for the stock to break past about that 250 hurdle, which I think could probably happen if the news flow and the events etc. pans out to be attractive for Zee. So I think right now the stock is consolidating. 200 is the lower end approximately as a base for Zee, and 250 is a resistance. So the stock is in a consolidation. Typically in a consolidations, when stock reaches into the lower end of the support range or the lower end of the range, we typically look out for more contrarian buy signals on the stock. So if you bought at 212, I think if you can average further, say at 200 or slightly lower than that, then I believe you can play in for some short-term trading range. But as I said, the bigger breakout for Zee could happen once the stock breaks past about that 250 hurdle.
All right, so that's a technical view. But Raghavendra, coming to you on the fundamentals, from what I've looked at in terms of the numbers for the December quarter, the revenues were quite decent in terms of a 33% rise, but there was pressure that was seen on the margin front, right? And there were concerns on cash flows as well that the analyst community had pegged. What is your view on the fundamentals of the stock?
For Zee Entertainment, on the fundamental side, we have 2 red flags. That first is the promoter holding, if you see, is less than 5%. That is very discomforting. Secondly, the promoter has pledged around 50 crores worth of shares. So that is again a yellow flag or a red flag if you consider. So Zee Entertainment would be an exit from current levels. Though the sales were up, there was pressure on the margins, but we believe that there has been concerns which still are currently present in terms of the corporate governance and the high debt levels of the company. Plus, on the macro side, there is large disruption from the OTT platforms like Netflix, Prime, and so forth. That could continue to put pressure on the margins for Zee. From current levels, one can look to exit and sell Zee Entertainment going ahead.
Okay, moving on to our last email query for the day. Ankit has written to us. He's holding on to shares of IRCTC at an average price of 1884. He wants our experts' advice on what he should do next with this particular investment. Kunal, It has been a steady gainer last 3 to 4 months. If you look at how the chart has panned out, but of course there was a bit of a correction in the last 2 weeks. Where do you think the stock is headed from these current levels, and what would be your advice?
So I think IRCTC and such kind of stocks are the ones which should be looked at as pure long-term plays, because these stocks have a tendency of setting up a trend and moving in a range for a shorter duration of time on the upside. But once the range gets shifted for stocks like IRCTC, we will see the stock consolidating for a long period of time. So it tests a lot of patience in terms of time rather than more of price choppiness. If you look at it, say for the second half of 2020, for example, IRCTC as a stock had remained in the range of 1400 plus or minus, I think 40-50 rupees approximately for almost a span of 5-6 months. And post that, we've seen the range shifting up higher from 1400 to 1600, and then from 1600 now to approximately 1750, 1800 as the pivot point of the range. So I think it's a stock which looks fairly attractive from the recent history and the recent chart patterns. But then again, I think it's a stock which has to be which you can invest, provided if your horizon is on a longer term scale. So IRCTC looks attractive, on charts specifically. But then again, I think the catch is if you're looking at it from a longer term play, then you can hold on to it for I would say a positional target of approximately 2,100 to 2,200 range.
Okay. Steady player for the long haul. Raghavendra, what's your view?
We believe that IRCTC could not fire in the last 2 quarters or so because the promoter holding, which is the government of India, has come down from in the last 1 year from 87% to current 68%. So there was tremendous supply in the market from the government in IRCTC. But that being over seems to be the case. The stock could fire up from here. With Mr. Piyush Goyal as the railway minister, we expect a lot of railway-specific reforms coming in the next few quarters that could augur very well for IRCTC. So hold for an upside of around 2,200 for at least 1 year from current levels of 1,750. That would be a recommendation on IRCTC, which is having a bullish undercurrent going ahead.
All right, on that note, I'd like to thank you, Raghavendra, as well as Kunal, for joining us and for sharing your views and for helping our viewers get answers to the queries that they sent in. Let's take you through an interesting conversation that ET Now had with market bull Rakesh Jhunjhunwala at the IEC, that is the India Economic Conclave. And one of the points that he was speaking about was the commodity cycle, and he believes that we might be heading into a commodity bull run that could last as much as 5 to 7 years. Certainly, those commodity-based stocks are actually trading quite well in today's session as well. Listen into what he said.
At the moment, I think the commodities, I think we are going into a very big commodity bull run, and which is going to last for the next 5-7 years. So I think at the moment commodity stocks are the best bets.
Sure.
Especially steel, and I want to make a SEBI declaration that I'm very much interested in the commodity sector.
Everything is being disclosed and disclaimed.
No, I have to
Sure.
I have to give it.
Sure.
Right, I'm very bullish on the commodities.
Meanwhile, if we look at the markets, the mid-cap index has outperformed in the last 1 year with a 100% return as compared to Nifty's 75% gain within the same span of time. However, the mid-caps are only correcting the underperformance in the last 3 years, and there could be room for more with an interesting pattern formation. Jayesh is joining us with an ET Now insight on the very same subject. Jayesh, take it away.
There is an interesting and rare chart pattern that has been formed on the weekly charts of the Nifty mid-cap index, and it does suggest that there could be some golden weeks ahead if this pattern is to play out, which is called as the golden cross formation on the weekly charts. As you can see on the screen, the 50-week moving average has crossed above its 200-week moving average. Remember that it has occurred only twice before in history, that is in 2010 and 2011. 2014. And each of these instances has resulted in an average gain of about 16.5% over the next 50 odd weeks. So definitely positioned on the bullish side. Let me just highlight the previous two instances. And one unique thing that I observed over here is that, once this chart pattern has been formed, the Nifty mid-cap starts its 3-year upcycle move. From 2010 to 2013, the Nifty surged about 20%, while the mid-cap index surged about 7%. This was the phase of the underperformance that we got from the mid-cap index. But have a look at 2014 to 17, where the Nifty surged about 67% and the Nifty mid-cap index surged a whopping 160%. So this is the cue that the market participants are watching out for after the underperformance of the mid-cap index since 2018.
All right, certainly something to watch out for. Thanks so much for that, Jayesh. We'll slip into a short break though. On the other side, we've got quite a few interesting things to talk about, so do stay tuned.